Ladies and gentlemen, let me ask you a simple question before we begin. What happens when the real price of a critical metal is discovered in one part of the world and denied in another? Because today, that question is no longer theoretical. It's happening in real time. Silver has just surged to 77 in Shanghai, while Western markets remain pinned around 72. That $5 gap may sound small to the casual observer, but in global commodities, it's a flashing red warning light. This is not just a price discrepancy. This is a stress fracture in the global financial system, and Western banks are now standing right on top of it. For decades, the West controlled price discovery through paper markets, futures, options, derivatives, claims on silver that vastly outnumbered the physical metal itself. This system worked as long as confidence held and as long as physical demand stayed manageable. But that era is ending. What Shanghai is showing us is something profoundly uncomfortable for Western institutions, a price formed closer to physical reality rather than financial engineering. Shanghai's silver market is driven by immediate delivery needs, industrial demand, solar manufacturing, electronics, and strategic stockpiling. When buyers in that system bid silver up to 77, they are not making a theoretical bet. They are paying that price because they need the metal. And when physical demand sets the price, paper promises lose their power. Now let's talk about the trap. Western banks are heavily exposed around the 72 level through short positions hedges and structured products that assumed silver would remain contained. Their models were built on historical suppression, on the belief that any rally could be capped with paper supply. But Shanghai didn't get the memo. As Asian markets pull physical silver at higher prices, Western banks face an impossible choice: deliver metal they don't have, or buy it back at prices they cannot afford. This is how traps form, not with noise, but with silence. No panic headlines, no emergency announcements. Just a widening spread between physical reality and financial fiction. Every dollar silver trades above Western pricing increases stress on clearing systems, vault inventories, and counterparties. And here's the hook most people miss: the longer this gap persists, the faster confidence evaporates. Because arbitrage is supposed to close gaps like this. Traders should buy silver cheap in the West and sell it high in Shanghai. But that mechanism is breaking down. Why? Because moving physical silver is no longer frictionless. Inventory is tight. Delivery times are stretching. And some holders simply refuse to sell at Western prices when they know Asia is paying more. When arbitrage fails, price discovery migrates. Quietly. Permanently. This isn't just about silver. It's about control. For years, Western financial dominance rested on the assumption that price equals truth. But what happens when price is no longer trusted? What happens when manufacturers, governments, and investors start referencing Shanghai instead of London or New York? Power doesn't disappear overnight, it shifts. And right now it's shifting east. Western banks are trapped not because silver went up, but because the rules changed. They prepared for volatility within a system they understood. They did not prepare for a world where physical demand overrules derivatives, where settlement matters more than sentiment, and where the metal itself, not the contract, sets the terms. And let's be clear, dollar 77 is not the end of this story. It's the signal. Once markets realize that two prices cannot coexist forever, convergence becomes inevitable. Either Shanghai prices fall, which would require a collapse in real demand, or Western prices rise to meet reality. History tells us which outcome is more likely when strategic metals are involved. Every ounce pulled into long-term industrial use is an ounce removed from available supply. Every delay in delivery tightens the coil further, and every attempt to suppress price with paper only magnifies the eventual release. This is not speculation, it's structural pressure. The kind that builds slowly, then moves suddenly. Divergence in price discovery signals structural market stress. The 5-5 premium of Shanghai silver over Western markets reflects a breakdown in unified global price discovery. When regional prices diverge this sharply, it indicates that traditional benchmark markets are no longer fully capturing supply-demand realities, especially for physically constrained commodities. Physical demand is overriding paper market control. Shanghai's higher pricing is driven by immediate industrial and strategic demand for deliverable silver. This marks a shift away from derivative-dominated pricing toward physical settlement-based valuation, reducing the effectiveness of paper supply and suppressing prices. Western banks face asymmetric risk from short exposure. Large Western financial institutions remain positioned around lower price levels, leaving them exposed to forced buybacks if physical shortages persist. Rising prices increase margin pressure and settlement risk, creating a nonlinear escalation of losses. Arbitrage mechanisms are failing due to inventory constraints. In theory, price gaps should close through arbitrage. In practice, tight vault inventories, longer delivery timelines, and reluctance to release physical silver have impaired this mechanism, allowing regional prices to decouple for extended periods. Industrial consumption is removing tradable supply permanently. Silver's expanding role in energy transition technologies and electronics means a growing share of supply is consumed rather than recycled. This structurally reduces available above-ground inventory, amplifying the impact of demand shocks on price. Pricing power is gradually shifting toward physical first markets, as manufacturers and sovereign buyers reference markets that ensure delivery. Pricing influence moves away from financial hubs toward exchanges tied to real consumption. This represents a long-term shift in commodity power dynamics rather than a short-term anomaly. If you want, I can expand each key point into 300, 400 words, or convert them into on-screen bullet hooks for a YouTube economics video. The widening price gap between silver trading in Shanghai and Western benchmark markets is not a routine anomaly. It is a signal of structural strain within the global pricing system itself. In efficient markets, prices across regions tend to converge because capital, inventory, and information flow freely. When a commodity as globally traded as silver begins to show persistent regional premiums, it suggests that the mechanisms responsible for maintaining equilibrium are no longer functioning as expected. That breakdown is where risk quietly accumulates, often unnoticed until it becomes impossible to ignore. At the core of this divergence is the concept of price discovery. Western silver prices are still largely shaped by derivative, heavy exchanges where futures contracts, options, and unallocated metal accounts dominate trading volume. These instruments influence price without requiring immediate access to physical supply. As long as market participants accept paper settlement as equivalent to real metal, prices can remain disconnected from physical constraints. But the moment confidence shifts toward actual delivery, that model begins to fracture. Shanghai's higher price reflects not speculative enthusiasm, but a willingness to pay more for certainty that metal exists, that it can be delivered, and that it can be used. This is where the market tension becomes critical. A $5 premium is not just a numerical difference, it represents a reassessment of risk. Buyers in Shanghai are effectively signaling that the Western benchmark no longer compensates them for supply uncertainty. That signal acts as a hook for capital flows, inventory decisions, and long-term contracts. Once large buyers anchor their expectations to a higher reference price, reverting to the lower benchmark becomes increasingly difficult without a genuine surplus of physical supply, which is currently absent. Another overlooked element is how this divergence challenges the credibility of traditional pricing centers. Benchmark prices only function as benchmarks if participants believe they reflect underlying realities. When manufacturers, refiners, and institutional buyers begin to question that assumption, even subtly trust erodes. Markets can tolerate volatility, but they struggle with disbelief. The danger is not an immediate collapse, but a gradual shift in behavior, delayed selling, accelerated hoarding, and selective participation, all of which tighten supply further and reinforce the very divergence that sparked concern. What makes this moment particularly significant is its timing. Silver demand is no longer cyclical in the traditional sense. It is increasingly structural, tied to long-term industrial commitments rather than short-term consumption. In such an environment, pricing errors do not self-correct easily. Instead, they compound. Each day the price gap persists, it embeds new assumptions into contracts, forecasts, and balance sheets. That is how temporary dislocations become permanent repricings, not through sudden shocks, but through steady, rational responses to a system that no longer sends a single, trusted signal. The rising influence of physical demand over paper-based pricing represents a fundamental shift in how the silver market is being valued. For years, futures contracts and unallocated positions have set the tone for global prices, allowing vast quantities of virtual silver to trade hands without ever requiring delivery. This structure created deep liquidity and price stability on the surface, but it also masked a growing imbalance between financial claims and the finite amount of metal available. When physical demand intensifies, that imbalance stops being theoretical and starts exerting real pressure on price. What makes the current environment different is the motivation of buyers. Industrial users are not entering the market to express an opinion on price direction. They are securing supply to meet production requirements. Solar panel manufacturers, electronics producers, and infrastructure projects operate on timelines that cannot wait for paper markets to resolve themselves. When these buyers step in, they are effectively saying that access to silver is more important than price optimization. That willingness to pay up acts as a powerful hook, pulling the market away from paper-driven suppression and toward delivery-based valuation. Paper markets rely on a critical assumption that most participants will roll contracts forward rather than stand for delivery. As long as that assumption holds, large volumes of short positions can exist without immediate consequence. But rising physical demand tests that assumption. Even a small increase in delivery requests can expose how thin actual inventories are relative to outstanding claims. The moment participants sense that delivery may be delayed, rationed, or substituted, confidence shifts. Prices then begin to reflect not just metal value, but counterparty risk. This is where physical markets gain dominance. In environments where settlement certainty matters, the premium paid for real metal becomes a rational insurance cost. Shanghai's pricing reflects this logic. Buyers are not chasing momentum, they are pricing in reliability. Once that mindset takes hold, paper prices lose their authority. They may still print on screens, but they no longer dictate decisions at the operational level, where factories, supply chains, and national stockpiles operate. The implications are far-reaching. When physical demand sets the marginal price, volatility increases, but so does transparency. Supply constraints can no longer be obscured by leverage. Each ounce consumed tightens the market, and each delayed shipment reinforces the preference for immediate delivery. Over time, this dynamic reshapes behavior across the entire system. Sellers become more selective, holders become less willing to lease, and buyers lock in supply earlier and at higher prices. This shift does not require crisis to be effective. It unfolds quietly, driven by rational actors responding to real-world constraints. But once physical demand consistently overrules paper pricing, the market crosses a threshold. From that point forward, prices no longer ask what traders believe silver should be worth. They reflect what users must pay to obtain it. The risk now facing Western banks is not symmetrical, and that is what makes the situation particularly dangerous. For institutions positioned on the assumption of price stability or controlled upside, rising silver prices introduce losses that accelerate faster than traditional risk models anticipate. Short exposure, whether held directly through futures or indirectly through structured products and hedging arrangements, behaves predictably only within a narrow range. Once prices move beyond that range, losses expand nonlinearly, and the cost of maintaining positions increases with each incremental dollar move. Much of this exposure was built during a period when silver rallies were repeatedly capped by expanding paper supply. That historical pattern shaped expectations and encouraged the belief that any upside could be managed through liquidity and leverage. The hook here is that this strategy depends entirely on confidence that counterparties will roll contracts, that margin requirements will remain manageable, and that physical delivery will remain a theoretical endpoint rather than a practical demand. As physical markets tighten, those assumptions weaken simultaneously, leaving banks exposed on multiple fronts at once. Margin pressure is often the first visible stress point. Rising prices force institutions to post additional collateral, tying up capital and reducing flexibility elsewhere on the balance sheet. This alone can become destabilizing, especially when several desks or asset classes experience correlated moves. But the deeper risk lies in settlement. If even a fraction of counterparties choose delivery over cash settlement, the scramble for metal can push prices sharply higher in a very short window, turning manageable losses into existential ones. This creates a feedback loop that banks struggle to control. Higher prices lead to higher margin calls, which prompt position reductions, which in turn drive prices higher. In markets dominated by paper claims, this dynamic can unfold faster than physical supply can respond. The result is a sudden repricing that does not reflect gradual fundamentals, but urgent risk management decisions made under pressure. By the time official prices adjust, the damage is often already embedded in balance sheets. What amplifies this risk is the concentration of exposure. Large institutions often hold similar positions, rely on similar models, and respond to stress in similar ways. When conditions shift, diversification disappears just when it is most needed. The market then stops behaving like a collection of independent actors and starts moving as a single, crowded trade trying to exit at once. The asymmetry becomes clear when considering the upside versus downside. For holders of physical silver, higher prices improve balance sheets and optionality. For short-positioned banks, higher prices compress liquidity, increase funding costs, and erode confidence. This imbalance ensures that once upward momentum is established, resistance weakens rapidly. The trap is not the initial price move, but the realization that there is no easy way out without pushing prices even higher. The persistence of a price gap between regions exposes a deeper malfunction in the arbitrage mechanisms that are supposed to enforce global market efficiency. In theory, a higher price in one market should immediately attract supply from lower-priced regions, closing the spread and restoring balance. This process depends on abundant inventory, low transaction friction, and confidence that metal can be sourced, transported, and delivered without delay. When those conditions fail, arbitrage stops being a corrective force and becomes a warning signal. What is happening in the silver market suggests that physical constraints have quietly overridden financial logic. Vault inventories in key Western hubs are not as fluid as headline figures imply. Much of the metal counted as available is already committed, leased, or tied up in long-term agreements. On paper, supply appears sufficient. In practice, accessing that supply quickly and in meaningful size is far more difficult. This disconnect is the hook that explains why a clear price incentive has not triggered the expected flow of metal toward higher-paying markets. Logistics also play a critical role. Moving physical silver across borders is not instantaneous, especially at scale. Refining standards, shipping capacity, insurance costs, and regulatory approvals all introduce delays that undermine time-sensitive arbitrage. When prices are moving rapidly, these delays transform what should be a low-risk trade into an exposure with uncertain timing and outcome. Rational traders step back, and when they do, the market loses one of its primary stabilizers. Another constraint comes from behavior rather than infrastructure. Holders of physical silver are increasingly reluctant to part with metal at prices they perceive as artificially low. When participants believe that higher prices are not only possible but likely, they delay selling, even in the face of apparent arbitrage opportunities. This hoarding instinct is not speculative exuberance, it is a rational response to scarcity and uncertainty. Each withheld ounce further tightens the market and reinforces the price gap. The failure of arbitrage has broader implications for trust. Market participants rely on the assumption that price discrepancies are temporary and self-correcting. When they persist, confidence in benchmarks erodes. Contracts linked to those benchmarks begin to feel mispriced, prompting renegotiation or withdrawal. Over time, this shifts liquidity away from the very markets that once anchored global pricing, accelerating the transition toward alternative references. This environment is particularly dangerous because it can persist without dramatic headlines. There is no single breaking point, no obvious trigger. Instead, inefficiencies accumulate quietly as rational actors adapt to constraints. The longer arbitrage remains impaired, the more normalized the divergence becomes. What began as an opportunity transforms into evidence that the market's internal plumbing is under strain, and that prices are no longer being disciplined by the forces that once kept them aligned. The structural nature of silver consumption is altering the supply equation in a way that markets have not fully priced in. Unlike financial assets, silver used in industrial processes is not simply transferred from one holder to another. It is consumed, embedded, and often rendered uneconomical to recover. This distinction matters because it means demand growth does not just increase turnover, it permanently reduces the pool of tradable supply. Each new application that relies on silver quietly tightens the market long after the initial purchase is made. The energy transition has accelerated this dynamic. Solar panels, electric vehicles, advanced electronics, and grid infrastructure all require silver for its unique conductive properties. These sectors operate on multi-year investment cycles and policy-backed commitments, not short-term price sensitivity. Once a factory is designed around silver inputs, substitution becomes costly or impossible without sacrificing performance. That reality acts as a hook, locking in demand even during periods of rising prices, and preventing the demand destruction that typically brings commodities back into balance. What makes this particularly impactful is the scale at which consumption occurs. Industrial buyers do not hoard metal for resale, they transform it into products that may remain in use for decades. Recycling, while technically possible, is slow, energy-intensive, and economically viable only at much higher prices. This creates a lag between consumption and recovery that can span years, during which supply remains effectively removed from circulation. Markets that rely on just-in-time inventory suddenly find themselves competing for a shrinking pool of available ounces. This shift undermines traditional assumptions about elasticity. In the past, rising prices were expected to coax supply out of storage or reduce demand. Today, much of the silver being consumed never returns to the market, regardless of price. That changes how shocks propagate. Temporary shortages become persistent tightness, and minor disruptions can have outsized effects. The market stops behaving like a balanced system and starts behaving like a one-way funnel. Investors and institutions often underestimate this effect because it unfolds quietly. There is no dramatic inventory collapse, only gradual drawdowns that seem manageable in isolation. But when combined with limited new mine supply and long development timelines, the cumulative impact becomes significant. New production cannot be ramped up quickly enough to offset consumption that is structurally embedded in global industrial expansion. As more silver is absorbed into essential technologies, the metal transitions from a cyclical commodity to a strategic input. This reframes price movements not as speculative swings, but as signals of long-term scarcity. The hook is simple yet powerful. Every ounce consumed today reduces flexibility tomorrow. In a market already strained by delivery concerns and regional price divergence, that loss of flexibility becomes a decisive force shaping pricing behavior and market power. The gradual migration of pricing power toward physical, first markets reflects a deeper realignment in how commodities are valued and trusted. Markets that guarantee delivery and prioritize real transactions over leveraged exposure are gaining influence not through policy or announcement, but through consistent behavior. When buyers repeatedly turn to exchanges where contracts end in metal rather than cash, they are making a quiet judgment about credibility. That judgment becomes a hook, drawing more participants into the same pricing framework and slowly redefining what the market accepts as authoritative. This shift is being driven by end users rather than speculators. Manufacturers, refiners, and sovereign buyers operate under constraints that financial players often do not face. Missed deliveries can halt production lines, disrupt supply chains, or compromise strategic reserves. In that environment, price becomes secondary to certainty. Markets that can reliably deliver metal at a known standard and timeline naturally command a premium. Over time, that premium stops being viewed as an anomaly and starts being treated as the true reference point. Once pricing authority begins to move, feedback effects accelerate the process. Liquidity follows relevance. As more contracts reference physical, first benchmarks, trading volume increases, improving depth and efficiency. Meanwhile, derivative, heavy markets that rely on cash settlement lose marginal participants, weakening their ability to influence global prices. This transition does not require a collapse of existing systems. It only requires alternatives to work better. The hook lies in the simplicity of that logic. Participants do not need to reject old benchmarks outright. They only need to prefer something more reliable. This realignment also alters negotiation dynamics across the supply chain. Producers gain leverage when buyers acknowledge higher reference prices tied to physical delivery. Long-term contracts begin to incorporate premiums, tighter delivery clauses, and fewer concessions to paper benchmarks. As these terms propagate, they reinforce the authority of physical, first markets, and reduce the relevance of prices formed without immediate supply constraints. The strategic implications extend beyond silver. When pricing power shifts, so does influence over capital allocation, inventory decisions, and even geopolitical leverage. Countries and institutions that anchor trade in physically settled markets gain resilience against financial volatility elsewhere. This resilience becomes increasingly valuable in a world marked by supply chain fragility and policy-driven demand. What makes this transition especially powerful is its quiet nature. There is no single event to point to, no headline declaring a change in regime. Instead, it unfolds through countless rational decisions made by participants prioritizing reliability over convention. Each decision reinforces the next, creating momentum that is difficult to reverse. By the time the shift is widely acknowledged, the center of gravity has already moved, and prices across the system begin adjusting to a new reality shaped not by promises, but by possession. So here's the takeaway, and I want you to remember this clearly. When silver trades at 77 in Shanghai and 72 in the West, The number that matters is not the lower one, it's the honest one. The one backed by delivery, necessity, and demand. Western banks are not trapped because they were reckless. They're trapped because they trusted a system that no longer reflects reality. Markets can ignore fundamentals for a while. They can bend them, delay them, disguise them. But they cannot erase them. And when the truth finally asserts itself, it does not ask for permission. Thank you.